Every civilization that's ever existed has faced the same problem. Every single one. From Rome to Weimar, Germany to Zimbabwe to Venezuela, they all printed money. They all debased their currency. They all destroyed their people's wealth, and they all collapsed. Here's what nobody's talking about. This isn't random. This isn't bad luck. This is the inevitable outcome of centralized monetary control. And it's happening right now in the United States. The dollar has lost 98% of its purchasing power since 1913. Let that sink in. 98%. Your great-grandfather's dollar could buy what would cost you $50 today. That's not inflation. That's systematic wealth transfer. You're watching the exact same pattern that destroyed Rome. The same mechanism that turned the German mark into wallpaper. The same system that made Venezuelans billionaires who couldn't afford bread. Let me show you exactly how this works, why it happens in every civilization, and why understanding this pattern is the difference between protecting your wealth and watching it evaporate. This isn't theory. This isn't conspiracy. This is recorded history repeating itself with mathematical precision. The signs are everywhere. The pattern is clear. And the timeline is accelerating. Here's what you need to understand. When governments control money, they always debase it. Always, without exception. In 5,000 years of recorded history, not one government has resisted the temptation. Not one. And right now, the Federal Reserve is creating money at rates that would make Roman emperors blush. This is happening, right now, to your savings, to your paycheck, to your future. To understand why inflation destroys every civilization, start with what inflation actually is. It's not rising prices. That's the symptom. Inflation is the expansion of the money supply, more money chasing the same amount of goods. Most people think inflation just happens naturally, like weather. Here's the reality. Inflation is always a policy choice. It's always created by those who control the money supply. It's always a form of hidden taxation. Let me show you how this works with a simple example. Imagine an island with 100 coconuts and $100 in circulation. Each coconut costs $1. Now the government prints 100 more dollars. There are still only 100 coconuts. What happens? Each coconut now costs $2. The coconut didn't change, its value didn't change, but your dollar's purchasing power just got cut in half. That's inflation, that's theft, and it's completely legal. Here's the mechanism governments use. They can't directly raise taxes. People revolt, so they print money instead. When they print, they spend it first at current prices. By the time that new money reaches you, prices have already risen. You're left holding devalued currency. This is called the Cantillon effect, named after Richard Cantillon, who observed it in 1730. Those closest to the money printer benefit. Those furthest away get robbed. Banks and governments win. Workers and savers lose. Look at the numbers. In 1970, the median home price was $17,000. Median income was $9,870. A home cost 1.7 times annual income. Today, median home price is $420,000. Median income is $74,580. A home costs 5.6 times annual income. Same houses, different money. The money supply tells the story. In 1960, M2 money supply was $312 billion. Today it's $21.4 trillion. That's a 800% increase. Over the same period, gold went from $35 per ounce to $2,000 per ounce. A 600% increase. Gold tracked the money printing almost perfectly. Here's what this means. Your labor, your savings, your retirement fund, they're all denominated in a currency that's designed to lose value. Systematically, permanently, by design. Case study. Your grandfather could work a summer job and pay for college. The average public university cost $329 per year in 1964. Minimum wage was $1.25. That's 263 hours of work. Today, public university averages $10,940 per year. Minimum wage is $7.25. That's 1,509 hours of work, same education, same labor. The only thing that changed was the money. This has happened before. Let me show you exactly how this pattern destroyed Rome, the most powerful empire in human history. They didn't fall to barbarians, they fell to inflation. In 64 AD, Emperor Nero started debasing the denarius. The Roman silver coin was 95% pure silver. Nero reduced it to 85%. Why? He needed money for wars, building projects, and bribes. He couldn't raise taxes, so he debased the currency. His successors followed the pattern. By 100 AD, the denarius was 85% silver. By 200 AD, it was 50% silver. By 270 AD, it was 5% silver. Over 200 years, they inflated away 95% of the currency's value. Here's what happened to Roman citizens. A bushel of wheat cost half a denarius in 100 AD. By 300 AD, the same bushel cost 200 denarii. That's a 0% increase in prices. Wages couldn't keep up. The middle class was destroyed. The government's response? Price controls. Emperor Diocletian issued the Edict on Maximum Prices in 301 AD. It fixed prices on over 1,000 goods. The penalty for violating was death. It failed completely. Goods disappeared from markets. The black market exploded. By 476 AD, the Western Roman Empire collapsed. Not from military defeat, from monetary collapse. The currency was worthless. Trade broke down. Cities depopulated. The economy returned to barter. 1,000 years of civilization ended because they couldn't stop debasing their money. The same pattern repeated in Weimar Germany. In 1914, $1 US equaled 4.2 German marks. The government printed to pay for World War I. By 1923, $1 equaled 4.2 trillion marks. In 9 years, they destroyed their currency completely. Germans who saved for retirement in marks were wiped out. A lifetime of savings couldn't buy a loaf of bread. Wheelbarrows of cash couldn't buy groceries. People burned money in stoves because it was cheaper than firewood. But here's the key. Some people got rich. Industrialists who owned hard assets. Those who borrowed in marks and paid back in worthless paper. Government insiders who got the printed money first. The pattern is always the same. Those close to the printer win. Everyone else loses. It's happening again right now. The exact same pattern. Different names. Same mechanism. Same results coming. Here's what's happening right now. And nobody's connecting these dots. The Federal Reserve's balance sheet was $900 billion in 2008. Today it's $7.8 trillion. That's an 866% increase in 15 years. They printed more money in the last 15 years than in the previous 95 years combined. Let me show you the evidence. March 2020. COVID hits. The Fed creates $4.5 trillion in 18 months. That's more money than existed in the entire U.S. economy in 1980. They called it quantitative easing. It's money printing, period. The result? Housing prices up 47% since 2020. Used cars up 52%. Eggs up 180%. Ground beef up 34%. Rent up 29%. Your paycheck up maybe 10%. You lost 20% of your purchasing power in 3 years. That's the largest wealth transfer in American history. Now here's what they're doing right now. The Treasury Department is issuing short-term debt instead of long-term. Why? Because they know long-term rates will explode. They're loading up on 1-year and 2-year bonds. When those mature, they'll need to refinance at higher rates. This is the debt spiral in action. Look at the spending. Federal spending was $4.4 trillion in 2019. It's $6.1 trillion in 2024. That's a 39% increase in 5 years. Revenue is only $4.9 trillion. They're running $1.2 trillion deficits every single year. And it's accelerating. Banks are repositioning. Bank of America sold $2.1 billion in treasuries in Q3 2024. J.P. Morgan increased gold holdings by 83% in the same quarter. They know something. They're moving assets before the public realizes what's happening. Corporate insiders are doing the same. In 2023, CEOs sold $32 billion in stock, the highest level since 2021. Jeff Bezos sold $8.5 billion in Amazon stock. Mark Zuckerberg sold $3.2 billion in Meta. Jamie Dimon sold JP Morgan stock for the first time ever. They're getting out. Central banks are buying gold. In 2023, central banks purchased 1,037 tons of gold, the highest level in 55 years. China added 225 tons. India added 18 tons. Poland added 90 tons. They're diversifying away from dollars, publicly, aggressively. This is not conspiracy, this is policy. The IMF released a paper in April 2024 discussing central bank digital currencies. They outline how CBDCs allow negative interest rates and expiring money. They're planning programmable currency that loses value automatically. Here's what this reveals. They know the system is breaking. They're preparing the replacement, and that replacement gives them even more control over your money, your spending, your savings, everything. The timeline is compressing. Housing affordability is at the lowest level since 1985. The average American needs $1,200,000 in retirement savings. The median American has $87,000. Credit card debt hit $1.13 trillion in 2024, a record high. Student loan debt is $1.77 trillion. People are drowning. Here's exactly how this works. Step by step, with real numbers, so you understand the theft that's happening to you right now. Let's say you have $100,000 in savings. You worked hard for it, sacrificed, saved. That $100,000 represents your labor, your time, your life energy converted to currency. Now the government runs a deficit. They need $1 trillion. They don't raise taxes. They issue bonds. The Federal Reserve buys those bonds with newly created money. They add $1 trillion to the money supply with a few keystrokes. That $1 trillion doesn't sit idle. The government spends it immediately. Defense contracts, infrastructure projects, social programs. That money enters the economy. But here's the key. Real goods and services didn't increase. Only the money supply increased. When X amount of money chases Y amount of goods, prices adjust. If you double the money supply without doubling production, prices double. Basic supply and demand, your $100,000 now buys what $50,000 bought yesterday. You just lost half your purchasing power. Nobody stole your money, they stole its value. But it's worse than that. The new money doesn't reach everyone equally. The government spends it first. Defense contractors get it first. They hire workers at current prices, buy materials at current prices. They benefit fully. By the time that money filters through the economy to you, prices have already risen. Your employer hasn't raised your salary yet. The grocery store has already increased prices. You're paying inflated prices with devalued money. You lose twice. This is the Cantillon effect in action. Those closest to the money creation point profit. Those furthest away suffer. Banks get the money first through Fed operations. They lend it out at current interest rates before inflation hits. Workers and savers get the money last, after prices have risen. Now multiply this over decades. The Fed has expanded the money supply by 10% annually on average since 1971. Compounding. Every year, your money loses 10% of its value every year just from supply expansion. Then add the velocity effects, the cascade effects, the compound destruction. A house that cost $25,000 in 1971 now costs $450,000. Not because houses got better, because money got worse. Your grandfather's $25,000 salary could buy that house. Your $75,000 salary can't. Same labor, different money. That's the mechanism. Who wins and who loses in this system? Let me show you exactly where you stand. Winners, asset owners, those who own real estate, stocks, gold, businesses. As money supply expands, asset prices inflate. A rental property that cost $200,000 in 2010 is worth $400,000 now. The debt stayed the same. The asset doubled. That's a transfer of wealth from currency holders to asset holders. Banks and financial institutions. They borrow from the Fed at 0.5% interest. They lend to you at 7% interest. They create the spread. Plus, they get the newly created money first. They lend it before inflation hits. They win twice. JP Morgan made $49.6 billion in profit in 2023, record high. Government and connected insiders, they spend the printed money first, at current prices, for current value. By the time it reaches the economy, they've already extracted the value. Defense contractors, government employees, subsidy recipients, they all benefit from fresh money. Debtors with fixed rates. If you borrowed $300,000 at 3% in 2020, you're paying back with inflated dollars. Your debt is fixed. Your income rises with inflation. The real value of your debt shrinks. This only works if your income keeps pace with inflation. Most people's doesn't. Large corporations, they borrow cheap money, buy back stock, inflate share prices. Executive compensation is tied to stock prices. They win. Apple has $162 billion in debt, but their stock price quintupled since 2015. Debt is cheap. Assets are inflating. Losers. Savers and cash holders. Your savings account pays 0.5% interest. Inflation is running at 7%. You're losing 6.5% per year in purchasing power every year. Compounding, a $50,000 emergency fund loses $3,250 in purchasing power annually. In 10 years, it's worth $32,500 in real terms. Fixed income retirees, you retired with $500,000. You need $25,000 per year to live. That's 5%. Inflation is 7%. Your nest egg shrinks 2% annually in real terms. In 20 years, you're broke. Social Security pays $1,827 per month average. That's $21,924 per year. Good luck surviving on that. Workers and wage earners. Wages lag inflation, always. Employers adjust salaries annually at best. Prices adjust daily. You lost 20% of purchasing power since 2020. Your raise was 10%. You're falling behind, permanently. The median wage in 1973 was $54,000 in 2024 dollars. Today it's $59,000. That's 9% growth in 51 years. Small business owners, your costs inflate. Rent, labor, materials, utilities, all up 30–40% since 2020. But you can't raise prices 40%. Customers revolt. Your margins compress. Many close. 170,000 businesses closed permanently during COVID. Large corporations bought the assets for pennies. Renters. Rent increased 29% since 2020. Your income increased 10%. You're paying a higher percentage of income on housing. The average renter now spends 35% of income on rent, up from 27% in 2000. You're being priced out of home ownership, permanently. The young and future generations. You're inheriting an economy where assets are inflated beyond reach. Houses cost 6 times annual income. College costs 4 times what it costs per hour of work. You start life buried in debt, chasing inflated asset prices, with devaluing currency. You lost before you started. You lost 98% of the dollar's purchasing power over 110 years. You lost 20% in just 3 years. You lost your future, your security, your wealth, not to theft, to inflation. Legal, systematic, permanent. Here's what you need to do. Now. Not tomorrow, not next month. The longer you wait, the more you lose. First, exit cash positions. Hold 3 to 6 months of expenses in cash for emergencies. Everything else needs to move into hard assets. Cash is melting ice. Every day you hold it, you lose. Target maximum 10% of net worth in cash and equivalents. Less if possible. Second, acquire hard assets, gold, silver, real estate, Bitcoin, productive businesses, assets that can't be inflated away. Target 10–20% in physical precious metals. Gold has maintained purchasing power for 5,000 years. It will outlast the dollar. Buy from reputable dealers. Take physical possession. If you don't hold it, you don't own it. Third, invest in productive assets. Stocks in companies with pricing power, real estate that generates income, businesses that provide essential services. These assets produce cash flow that adjusts with inflation. Target 40–50% in productive assets. Focus on quality. Avoid speculation. You're protecting wealth, not gambling. Fourth, eliminate bad debt, maintain good debt. Pay off high-interest consumer debt immediately. Credit cards, personal loans, that's toxic. But keep low fixed-rate mortgage debt. If you borrowed at 3% and inflation is 7%, you're winning. The debt is shrinking in real terms. Lock in long-term fixed rates while you can. Fifth, increase income and skills. Your labor is your most important asset. Make yourself indispensable. Learn high-value skills. Start a side business. Create multiple income streams. When currency devalues, skills and relationships maintain value. Invest in yourself harder than anything else. Sixth, educate yourself continuously. Study monetary history. Understand the patterns. Read economics, not the academic propaganda. The real history. Rome, Weimar, Zimbabwe, Venezuela. The pattern repeats because human nature doesn't change. Those who know history protect themselves. Those who don't get destroyed. Seventh, build community and relationships. When systems break, communities survive. Build relationships with skilled people, doctors, mechanics, farmers, builders. In a currency crisis, barter and trade networks form. Position yourself in those networks before you need them. The window is closing. Real estate is already inflated. Gold is at highs, but it's going higher, much higher. The alternative is watching your savings evaporate. Move now. Position yourself now. Protect yourself now. The pattern is clear. Every civilization that centralizes monetary control eventually debases its currency. Every civilization that debases its currency collapses. No exceptions, not one. In 5,000 years, the United States is following the exact same path, same mechanism, same warning signs, same outcome approaching. The only question is timing, and whether you'll be positioned to survive it. The choice is yours. You can pretend this isn't happening, keep your savings in dollars, watch them evaporate. Or you can act, move into hard assets. Protect your wealth. Position yourself to survive what's coming. This is not financial advice. I'm not your financial advisor. Do your own research. Verify everything I've said. Study the history. Look at the data. Then make your own decision. But understand this. The inflation is already here. The wealth transfer is already happening. Your purchasing power is already falling. Every day you delay is another day you lose. Join our membership for weekly updates on monetary policy, asset protection strategies, and economic analysis. Link in the description. We track this full-time so you don't have to. Share this video with everyone you know, your friends, your family, anyone who's working hard and watching their money buy less. They need to understand this mechanism. They need to protect themselves. Check the links below for resources, books on monetary history, precious metals dealers, real estate investment strategies, educational materials, everything you need to take action. The system is designed to transfer wealth from you to those who control the money. That's not conspiracy. That's policy. That's history. That's happening right now. Position yourself now, before it's too late. Not financial advice. Do your own research, but do it now.